Is there something which companies can do to affect trading behaviour in their stock? While market design change has typically been the province of regulators, exchanges and financial intermediaries, a new piece of research by the CMCRC has highlighted how investors and corporates, the two parties that bear the consequences of market design change through increased cost of capital and cost of trading, can play a greater role in the market design debate. Companies ultimately have control over their share price level, which can be adjusted by modifying the number of shares on issue via a stock split or reverse stock split. This simple change, which can be enacted by management, impacts a firm's relative tick, or the reward earned by providers of liquidity, which high-frequency traders are so often perceived to be. High-frequency trading has significantly changed the underlying market structure. A large body of research has addressed the issue of whether HFTs have improved markets, but the jury remains out on whether HFTs have improved market quality. Institutional investors have perhaps been the most vocal in highlighting that the new technology introduced in markets has made markets unnecessarily complex, and that advances in speed have created an order book filled with excessive messaging and cancellation, perhaps to the advantage of high-frequency traders. The research by the CMCRC evaluates the relationship between relative tick size and algorithmic trading around stock splits and reverse stock splits, providing a natural experiment to evaluate HFT behaviour around major tick changes. Presented in this chart is algorithmic trading, or HFT proxy, the order to trade ratio, 13 weeks pre and post a firm completing a stock consolidation or reverse stock split. Stock consolidations cause a firm to move from a relatively large tick trading environment to a small tick trading environment. The red line shows what happens to HFT participation following reverse stock splits undertaken during 2009 to 2012. As you can clearly see, following the event, the order to trade ratio increases significantly and remains elevated. The blue line, however, charts trading behaviour around stock consolidations completed during 1996 to 2004. As expected, we observed no change, as HFTs were not major players in capital markets during those times. The study also examines splits and finds algorithmic trading proxies drop off immediately following the split. Together, these results highlight that HFTs are attracted to stocks where the cost of getting ahead in the order book is minimal. One implication of this research is that a listed firm may potentially be able to influence the trading in its stock without the need for regulation. For example, a firm may limit the proportion of trading in their stock by algorithmic traders by undertaking a stock split, which will increase its relative tick. Calls for larger ticks have also been made by institutional investors, who argue large ticks lead to an investment market which favours long-term investors and increases investor confidence by reducing the number of price points at which stocks trade. The debate around tick size intensified in 2014, with several exchanges now revisiting this component of market protocol, with calls for various alternatives and trials. CMCRC researchers stand ready to evaluate these trials with its market quality dashboard developed to evaluate market design changes in minutes.